Hey guys, in this video, we're talking all about shareholder loans. If you've ever opened up a set of books, seen a shareholder loan account on the balance sheet and thought, what is this? Why is this here? What am I supposed to do with it? You're definitely not alone. This is one of those things that can be confusing at the start, but by the end of this video, you'll understand what shareholder loans actually are, why they show up once a business incorporates, how they're used during the year, where things usually go wrong, and exactly what your role is as the bookkeeper when you see them. And don't forget to grab this handout that goes along with this video. You can find it inside our AIR Support Club. So first up is, what is a shareholder loan? Well, a shareholder loan is an account that simply tracks money moving between the owner of the company and the company itself. When a company is incorporated, the owners receive shares in that company. Once you own shares, you're considered a shareholder. And once a business is incorporated, the business and the shareholder are treated as two separate entities. Because of that separation, anytime money moves between the shareholder and the business, whether that's the shareholder putting money into the business or taking that money out, we need a place to track that activity. So that's where the shareholder loan account comes into place. It's just a balance sheet account that says, okay, the shareholder put money into the business, or okay, the shareholder took money out of the business. And honestly, this account exists because, real business has a lot of moving pieces. People grab the wrong card, owners pull money out to live, they pay for business things personally, or the business is brand new and it doesn't have cash flow yet, so the owner covers expenses out of pocket. All of that is just money moving back and forth between the shareholder and the business. The shareholder loan account exists so we can track that without things getting weird on the books. Now, here's where the business structure starts to matter. So in some businesses, like a sole proprietorship, the business and the owner are treated as the same thing for tax purposes. The business earns profit, and that business profit is automatically considered personal income to the owner, whether or not they take the money out or not. They're one entity. In those cases, tracking money moving back and forth between the business and the business owner is still really useful from a bookkeeping perspective, but it's less critical because profit and personal earnings are already treated as the same thing. So where this becomes much more important is in a business structure where there's a separation between business profit and personal income. So in those structures, the business can earn a profit without that profit automatically becoming the owner's personal income. And the owner can take money out of the business in different ways. When that separation exists, it becomes really important to track when money is actually moving between the business and the owner. And that's because personal income is triggered based on how and when owners take money out, not just simply because the business earned a profit. So tracking this movement between the owner and the business is never wrong to do, no matter what the structure is. In business structures where profit and personal income aren't automatically the same thing, it becomes essential. So that's why the shareholder loan account shows up and why it matters so much in those situations. So next, let's talk about where this account actually lives on the financial statements. The shareholder loan account lives on the balance sheet, and that's because it's tracking who owes who. It's not income and it's not an expense. Either the business owes money to the shareholder or the shareholder owes money back to the business. We don't want this showing up in the profit and loss statement or the income statement because the P&L is meant to show how the business itself is performing. So personal spending shouldn't suddenly make the business look unprofitable, and owners putting money into the business shouldn't suddenly look like revenue. The balance sheet is where we track loans, receivables, and obligations, and that's exactly what the shareholder loan represents. Okay, so how do we actually use this account during the year? Well, you might see this account show up under a bunch of different names on your client's financial statements. So sometimes it's shareholder loan, paid by owner, owner's funds, loan from owner, loan to owner. So different names, but it's all essentially the same idea. Anytime money is moving between the shareholder and the business, it goes here. So for example, let's say a personal purchase hits the business credit card. Instead of recording that as a business expense, we'd record it to the shareholder loan account. What really happened is the shareholder took money out of the business and essentially just skipped a step. The clean version would have been for the owner to take money out as earnings, pay the appropriate personal tax on that money, and then use that after-tax money to buy that personal item. But As we know, real life doesn't always work that way, and that's completely fine, but the shareholder loan account lets us fix that after the fact. The same thing applies in reverse. If the owner pays for a business expense personally, we don't record that as income. We track it here so it's clear that the business owes the shareholder back for what was borrowed from them. During the year, this account basically is a holding place where we're tracking the activity of money moving back and forth, but we're not making any decisions from it yet. Now, here's where things tend to go wrong with a shareholder loan account. So the biggest issues don't come from having a shareholder loan account balance or having it be a positive or a negative sitting on the balance sheet. It comes from just the fact that people just don't use it or they're really sloppy about using it. So when it isn't tracked correctly, often what happens is personal purchases get mixed in with business expenses and end up getting recorded in the business's books. And a lot of times those expenses wouldn't be deductible because they don't relate to the business. At the same time, the shareholder has now effectively had the business pay for a personal item for them, but has never claimed that money as personal earnings. They skipped the step of taking the funds out of the business and instead just had the business buy the personal thing directly. So now personal income would be understated too. This results in both business income and personal income being too low, which means the taxes that then get calculated on those numbers are going to be too low as well. And when that happens, the government will get less money, and they don't like that. So that's why governments tend to pay so much attention to this area. So if it isn't dealt with properly, there can be consequences, and it essentially becomes that the business's expenses can be denied because they don't relate to the business, and the business will then owe more tax plus interest and penalties on the differences when those expenses are denied. The shareholder can also be reassessed and they'll owe more personal tax plus interest and penalties on there as well. Now, if we assume that everything was tracked properly throughout the year, what happens next? Well, at year end, we're going to be left with a balance in the shareholder loan account. And what normally happens is if you have a bunch of different accounts that all mean the same thing, you're going to amalgamate them, which is a fancy way of saying combine them all together. And the question simply becomes who owes who. So if the business owes money to the shareholder, that's generally not a problem. Governments don't really tend to care if the owner funds their own business, but where attention starts to come in is when the shareholder owes money back to the business, meaning they've taken funds out of the business personally in the year. At that point, some questions become whether the balance is truly a loan or whether it represents personal income to the shareholder. So different countries handle this question a little bit differently. In Canada, it's more about the timing of how long the funds have been in the hands of the shareholder, whereas in the States, it's more about the intent of how the funds are being used. And this is normally where an accountant steps in and helps decide how that balance should be treated. From a bookkeeping perspective, our job is just to make sure that the balance is accurate and clearly reflects what happened during the year and the movement between the business and the shareholder. And that leads us into your role as the bookkeeper. So as bookkeepers, we're not responsible for deciding tax outcomes. We're usually not the ones filing corporate or personal tax returns. It's our responsibility to track the movement of money between the shareholder and the business clearly and accurately. That means asking questions when something doesn't look like a business expense and helping owners understand the difference between business spending and personal spending. Most business owners aren't trying to do anything wrong. They usually just think to themselves, oh, it's my business, it's my money, it doesn't matter which card I use. The entire reason the shareholder loan account exists is because real money moves between the business and the shareholder all the time. People grab the wrong card, owners need to take money out to live, and that's completely normal. We just need to make sure that we are tracking and labeling it correctly. So hopefully this video helped you understand shareholder loans a little bit more, and I'll see you in the next one.